Welcome everyone. Today we are going to talk about something very important for anyone interested in the stock market. We are going to discuss what an order is in the stock market, how it works, and why it is essential for making trades. By the end of our time together, you will know the different types of stock orders, when to use them, and how they can help you make better decisions. I am excited for us to get started. Imagine you are standing at the doorway of the stock market, ready to dive in. The first thing you need to know is how to communicate with the market. How do you buy a stock, or how do you sell it when the price is right? This is where orders come into play. So, what exactly is an order in the stock market? Simply put, an order is a way to give instructions to your broker to buy or sell a stock. It is how you make trades. Whether you are buying shares to grow your investments or selling to take your profits or cut your losses, placing an order is the way to get it done. Understanding the different types of orders is very important, as they decide when and at what price your trades are made, and that can directly affect your profits or losses. To better understand how stock prices move, it is helpful to learn about chart patterns. Chart patterns are visual representations of a stock's price movement over time. These patterns help traders predict future price movements by analyzing historical data. Some of the most well-known chart patterns include the head and shoulders, double top, double bottom, triangles, and flags. Recognizing these patterns can give you insight into potential market trends and help you make more informed decisions. One of the most popular chart patterns is the head and shoulders pattern. This pattern usually signals a reversal of a trend. It consists of 3 peaks. The first and third peaks are smaller, while the middle peak is the highest, resembling a head with 2 shoulders. When this pattern forms, it suggests that the stock's price may soon change direction, giving traders a chance to act before a potential reversal. Another common pattern is the double top. The double top occurs when a stock's price rises to a certain level, falls, and then rises again to approximately the same level before dropping. This pattern often signals that the stock is struggling to move higher and that a reversal might be on the horizon. On the other hand, the double bottom is a bullish pattern where the stock's price drops, rises, and drops again to a similar level before moving up. This indicates that the stock may have found a support level and is likely to increase in value. Triangles are another type of chart pattern that can help traders make decisions. There are 3 main types of triangles: ascending, descending, and symmetrical. An ascending triangle is formed when the stock's price makes higher lows while facing resistance at the same level, indicating a potential breakout to the upside. A descending triangle, on the other hand, forms when the price makes lower highs while finding support at the same level, often suggesting a breakdown. Symmetrical triangles indicate a period of consolidation where the price is making both lower highs and higher lows, and the eventual breakout could be in either direction. Flags and pennants are continuation patterns that signal a brief pause in a trend before the price continues in the same direction. A flag forms when the stock's price moves sharply in one direction, followed by a brief period of consolidation in a channel that slopes against the prevailing trend. Pennants look similar to flags, but they form a small, symmetrical triangle instead. Both of these patterns suggest that the price is likely to continue moving in the direction of the original trend once the consolidation period ends. Understanding these chart patterns and how they work can be very helpful in planning your trades. By recognizing these patterns, you can gain a better idea of where the price might go next, helping you make more informed decisions on when to enter or exit a trade. Chart patterns are not a guarantee, but they are a useful tool to include in your trading strategy. To begin, let us talk about the simplest type of order, which is the market order. A market order tells your broker to buy or sell a stock right away at the best price available. This is a great way to get your trade done quickly. Market orders are very useful if you need to enter or exit a trade fast, but remember, the price you see on the screen is not always the price you will get. Prices can change fast, especially when there are a lot of trades happening at once. So, while market orders are good for speed, you might get a different price than you expect. This difference is called slippage, and it is something to be aware of. When looking at chart patterns, understanding how to use market orders effectively can be important. For example, during a breakout from a significant chart pattern like a triangle or flag, a market order can help you enter the trade quickly to take advantage of the momentum. However, be cautious, as fast-moving markets during breakouts can also lead to significant slippage, which could affect your returns. A *** break out ** is when the price moves beyond a defined resistance or support level, and it often signals the beginning of a new trend. Market orders are commonly used during breakouts because they allow you to get in on the movement right away. However, traders should be mindful of ** false breakouts **, which occur when the price moves past a key level but then quickly reverses. This is where combining different order types, like a market order to enter and a stop loss to protect against reversals, can help manage risk more effectively. Market orders are also used during ** volume spikes **, which often occur when a stock is moving quickly due to a significant news event or earnings report. During these times, prices can be very volatile, and slippage can become more pronounced. In these situations, a market order can be beneficial if your priority is simply to enter or exit the trade as fast as possible, regardless of price fluctuations. However, to mitigate potential losses from slippage, consider setting a stop-loss order immediately after entering the trade. Next, let us talk about limit orders. A limit order lets you set a specific price that you are willing to pay to buy or sell a stock. With a limit order, your trade will only happen if the stock reaches the price you have chosen. This means you have more control over the price of your trade, which is great for making sure you do not pay more than you want to or sell for less than you planned. However, with a limit order, you may need to be patient, because if the market never reaches the price you have set, your trade will not happen. There is also something called a partial fill. If there are not enough shares available at the price you set, only part of your order might get filled, and the rest will stay open until it is filled completely or you cancel it. Now let us talk about stop orders. You may have heard of a stop order called a stop-loss order. A stop-loss order is used to protect yourself from losing too much money. It works by turning into a market order if the stock reaches a certain price. This means if the price of the stock drops to your set price, the order will make sure the stock is sold to prevent more losses. Stop orders are especially helpful if you cannot watch the market all the time. There is also a buy-stop order, which is used to buy a stock once its price reaches a certain level. This is often used to enter a trade when you believe a stock will continue to rise after hitting a specific price. If you are in a winning trade, there is another type of stop order called a trailing stop order. A trailing stop moves up with the stock price, which helps you hold on to your gains while also protecting you from a big drop. For example, you can set a trailing stop order to follow the stock by a specific dollar amount or percentage. If the stock continues to rise, the trailing stop will adjust upwards, locking in more profits as the price increases. However, if the stock price falls by the set amount or percentage, the trailing stop will trigger and your stock will be sold, securing your gains. Something to know about stop orders is that when the price is hit, your stop order becomes a market order. This means that the actual price you get could be lower than what you expected if the market is moving fast. This is another example of why it is important to understand the risks involved with each type of order. Let us now talk about some settings that control how long your order stays active in the market. One of these settings is called time in force, and it affects how long your order stays open. The first option is a day order. A day order is only valid for the current trading day. If the order is not filled by the end of the day, it will be cancelled. A day order is a good choice if you want your order to be active only during regular market hours. Another option is called a good until cancelled order. This order will stay open until it is filled or until you cancel it. This is useful if you want to wait for a specific price and you do not know how long that will take. There is also the immediate or cancel order. This order is different because it has to be filled immediately. And if it cannot be filled completely right away, the part that is not filled will be cancelled. Now that we have talked about the different types of orders, let us talk about how you can use them together to create a strategy. One common strategy is using something called bracket orders. With a bracket order, you can place a limit order to take a profit and a stop-loss order to protect against losses at the same time. Once one of these orders is completed, the other order is cancelled. This way, you can manage your trade without having to do everything yourself. You might also hear this called a one cancels the other order. Another strategy is to combine a buy limit order with a stop loss order. For example, you could place a buy limit order to enter a trade at the price you want, and at the same time set a stop loss just below that price to protect yourself if the stock moves in the opposite direction. Let us now expand on the use of chart patterns to further enhance your trading strategy. Chart patterns are helpful in deciding when to place different types of orders and can greatly influence your decision-making process. For instance, if you recognize a head and shoulders pattern forming, you might decide to use a bracket order to maximize profits while protecting yourself against a sudden reversal. When the price starts to approach the neckline of the head and shoulders pattern, you could place a stop order to enter the market when the reversal is confirmed, and also set a limit order to exit the position at a profit once the movement begins. Another powerful chart pattern is the ** cup and handle ** pattern. This pattern resembles a teacup, with the cup part representing a rounded bottom and the handle indicating a brief consolidation period. The cup and handle is often a bullish continuation pattern. When you spot a cup and handle forming, you might consider placing a buy stop order slightly above the resistance level of the handle to capitalize on an upward breakout. A stop-loss order can be placed just below the handle to protect against any false breakouts. The ** rising wedge ** and ** falling wedge * are also important chart patterns. A ** rising wedge * forms when the price makes higher highs and higher lows, but the range is getting tighter, indicating a potential bearish reversal. In this scenario, you might set a sell stop order just below the lower trend line of the wedge to catch the breakout. Conversely, a ** falling wedge * occurs when the price makes lower highs and lower lows, with the range narrowing, often indicating a bullish reversal. A buy stop order above the wedge can be useful to enter the trade when the breakout occurs. Another valuable pattern to recognize is the *** rounding bottom ***. This pattern forms a U shape and signals a potential reversal from a downtrend to an uptrend. Once the price starts to rise after forming the rounded bottom, you could place a buy limit order near the breakout point and set a stop loss below the base of the rounding bottom for protection. This pattern often suggests a strong upward movement, especially if the volume is increasing. The *** triple top *** and *** triple bottom ** are also similar to double tops and bottoms, but involve 3 peaks or valleys instead of 2. A *** triple top ** indicates that the stock has tried and failed to break through resistance 3 times, signaling a potential reversal to the downside. A *** triple bottom ** suggests that the stock has tested a support level 3 times and may now be primed for a bullish move. Placing a sell limit order after confirming a triple top or a buy limit order following a triple bottom can help capture the anticipated movement. *** rectangles ** are consolidation patterns where the price moves sideways between a defined support and resistance level. When the price breaks out of the rectangle, it typically continues in the direction of the breakout. You could set either a buy stop order above the resistance or a sell stop order below the support to enter the trade in the direction of the breakout. A stop loss should be placed inside the rectangle to manage the risk. By thoroughly understanding and identifying these chart patterns and combining them with appropriate order types such as limit orders, stop losses, and bracket orders, you can create a well-rounded trading strategy that helps you capture opportunities while managing risks effectively. Chart patterns can offer a window into market psychology, allowing you to anticipate where prices may go next and plan your trades accordingly. If you see a double top forming, you might use a limit order to enter a short position as soon as the stock fails to break the resistance level for the second time. A stop loss order can then be placed just above the resistance level to manage risk if the price unexpectedly continues to rise. Similarly, for a double bottom, you might choose to place a buy limit order when the stock begins to rise after the second bottom, with a stop loss placed just below the support level. Triangles are another useful chart pattern in developing your strategy. If you identify an ascending triangle, you could set a buy stop order slightly above the resistance line. This way, your trade is only triggered if the price breaks out in the expected direction. At the same time, you can place a stop loss order below the ascending trend line to protect yourself if the breakout turns out to be false. In the case of a descending triangle, you could use a sell stop order below the support level with a stop loss above the descending trend line. Flags and pennants are continuation patterns that offer great opportunities for using limit orders and stop loss orders. For a flag pattern, once the price breaks out of the flag, you could place a buy limit order to catch the movement at a good price, with a stop loss order below the recent consolidation to manage risk. Pennants work in a similar way, and placing a stop loss order below the pennant ensures that you are protected if the market moves against you. By combining your understanding of chart patterns with different types of orders, you can create a more robust trading strategy. This allows you to capitalize on potential price movements while also managing your risk effectively. The more you understand these patterns and their implications, the better you can plan your entries and exits, improving your overall trading results. Understanding the flow of orders can also help you see how the market moves. If there are more buy orders than sell orders, the price of a stock will usually go up. On the other hand, if there are more sell orders, the price will go down. Watching how orders are moving in and out of the market can give you an advantage in predicting where the price might go next. There is also something called the order book. The order book shows all of the current buy and sell orders for a stock. By looking at the order book, you can see how much interest there is in buying or selling at different price levels. This can help you make better decisions about when to enter or exit a trade. It is also important to think about market conditions when you are placing orders. In a market that is very volatile, meaning prices are changing a lot and quickly, the price that you expect may not be the price you get. In these cases, a limit order can help you make sure that your trade only happens at the price you want. There is also something called liquidity. When a stock does not have many buyers or sellers, it is said to have low liquidity. In a low liquidity stock, placing a large order can move the price in a big way. In these situations, a limit order can help you avoid having a large impact on the price. Now let us talk about some risks and mistakes that people make with orders. One of the biggest mistakes is placing orders without a plan. It is always important to have a clear strategy, which means knowing when you want to enter and exit a trade and where you will put your stop loss to limit your risks. You also need to think about your time in force settings. You do not want a day order to expire if the stock has not reached your price yet, so make sure the order length fits your strategy. Here are some tips for managing your orders effectively. First, always use stop losses to protect your trades, especially in markets that are moving fast. A stop loss can help limit your losses if the price moves against you. Second, remember to check on your orders to see if they are still a good fit for what is happening in the market. Sometimes you may need to adjust or cancel an order if things have changed. Third, make sure to understand the chart patterns that are forming, as these can give you valuable insights into how the stock is likely to behave. Recognizing patterns like head and shoulders, double tops, double bottoms, triangles, flags, and pennants can help you decide when to adjust your orders to maximize profits or minimize losses. Let us go into more detail on these chart patterns to help you understand them better. The ** head and shoulders ** pattern is a classic reversal pattern indicating that an uptrend might be coming to an end. It consists of 3 peaks, a higher peak in the middle, known as the head, and 2 smaller peaks on either side, known as the shoulders. The line connecting the 2 troughs between these peaks is called the neckline. Once the price breaks below the neckline, it typically signals a reversal. Conversely, an ** inverse head and shoulders * is the opposite, and it signals that a downtrend might be ending and a new uptrend could begin. The ** double top * pattern occurs when the price reaches a high point, retraces, and then reaches the same high point again before falling. This suggests that the stock has found strong resistance and a downward reversal is likely. On the other hand, a ** double bottom * occurs when the price hits a low point, rises, and then hits the same low point again before rising further, indicating strong support and a potential upward reversal. **, triangles * are powerful patterns that can be used to predict a breakout. The ** ascending triangle * forms when there is a resistance level with higher lows forming beneath it, suggesting that buyers are gaining strength. A breakout above the resistance is typically a bullish sign. The asterisk descending triangle asterisk has lower highs converging towards a horizontal support level, indicating growing selling pressure, and a breakout below the support is typically bearish. The asterisk symmetrical triangle asterisk occurs when both the highs and lows are converging towards each other, and it suggests that a significant breakout could occur in either direction, depending on whether buyers or sellers gain control. Asterisk flags asterisk and asterisk pennants asterisk are continuation patterns that indicate that the market is taking a brief pause before continuing the previous trend. A flag pattern resembles a small rectangle slanting against the trend after a sharp move. This is often a sign that the market is catching its breath before the trend resumes. Asterisk pennants asterisk are similar to flags but form small symmetrical triangles. Both patterns suggest that once the consolidation ends, the price will continue in the same direction as before. By gaining a thorough understanding of these chart patterns and using them in conjunction with stop losses, limit orders, and other strategies, you can significantly improve your ability to manage risk and capture profitable trading opportunities. And lastly, try not to place too many orders all at once. It is better to focus on a few orders that are well thought out rather than trying to handle many trades at once, which can be hard to manage. Let us do a quick recap. An order is the way you tell your broker to buy or sell a stock, and there are different types of orders for different situations. Market orders are fast but may have a different price than you expect. Limit orders give you control over the price, and stop orders help protect you from large losses. The key to success is knowing when and how to use each type of order to manage your trades effectively. Do you feel you are getting more comfortable with these concepts? It is important to keep practicing these skills and refining your strategy. Remember that every trade is a learning opportunity, and the more you learn, the better you will get at making smart decisions in the stock market. I hope this has helped you understand more about how orders work and how they can help you reach your trading goals. If you have questions or if there is anything more you would like to know, keep asking and keep learning. Understanding how to manage orders is a big step towards becoming a successful trader.